Welcome to the Deep Dive. We cut through the noise of market intelligence to bring you what really matters. Today, we're diving into Gladstone Investment Corporation, ticker GAIN. We're looking at their first quarter fiscal year 2026 earnings call, which happened pre-market August 13th, 2025.
Yeah, and this one's particularly interesting. GAIN is a business development company, a BDC. And that whole sector, well, it's under the microscope right now. Rising rates, lots of competition for deals. It makes this deep dive pretty relevant.
Okay, so let's jump right into the results. The Q1 FY26 numbers just dropped, and it's a bit of a mixed bag, but some really positive signs underneath. First up, adjusted net investment income, NII, came in between Dulls and $24.25. That actually beat the consensus estimate, which was hovering around 23 cents. And crucially, it was enough to cover their monthly distribution.
Right, covering the distribution is key, especially now. Shows real operational strength, solid cash flow.
Definitely. But on the flip side, revenue slightly missed. They reported $23.54 million. The consensus was what, about $23.87 million?
Yeah, small miss there. But importantly, year-over-year revenue growth was still pretty healthy, 6.2%. And they did grow total assets too, up to about $1.1 billion from $1.0 billion last quarter.
Yeah.
So, expansion is happening.
Right, expansion. But then there's the net asset value, the NAV per share. That saw a little dip, came in at $12.99, down from $13.55.
But here's the thing, and it's easy to misread this. Management said that dip was mainly because they paid out significant distributions to shareholders, not because of bad assets or operational problems. They paid out $0.78 per share total, including a big $0.54 supplemental in June.
So it's what you might call a good NAV dip, really.
Yeah. Returning
capital, showing they had successful exits, not a red flag.
Exactly. Now, the market's immediate reaction, a bit muted. The stock slipped about 0.77% in after-hours trading after the release. Suggests investors were maybe a bit cautious despite that EPS beat, probably weighing the revenue miss, maybe just broader economic worries?
Yeah, sort of a neutral, maybe cautiously optimistic vibe, a wait-and-see thing, perhaps?
Seems like it.
Okay, let's get into the deeper stuff then. The financial performance, the strategy. What really jumped out at me was the investment activity. It really accelerated. They put $130 million to work in Q1 across 3 new portfolio companies.
Yeah, that's a big number, especially when you think they invested $221 million in all of the last fiscal year.
Right. It feels like a definite strategic shift. More active deployment. David Dullam, the president, even said, "We are seeing good quality of deals and we're very active." What's that signal about their confidence?
Oh, it signals huge confidence, and they've got the firepower to back it up. Their liquidity looks really solid. They mentioned having $151 million available on their credit line. Plus, another $19.3 million came in from their at-the-market stock program, the ATM.
So they can move quickly when they see a good deal.
Exactly. And they plan to keep using that ATM program, when the stock price makes sense, when it's accretive to NAV. And they're also looking at debt financing options. Gives them flexibility.
Okay, great pace, strong liquidity. But what about the actual operational income this quarter?
Yep.
Sometimes the headline numbers hide things. Total investment income was $23.5 million. That's actually down from $27.5 million last quarter. Seems off.
Well, yeah, at first glance, maybe. But management explained that. A lot of that previous quarter's income was from non-recurring stuff, like success fees and some dividends, one-offs, basically. But here's the interesting part. Net expenses dropped quite a bit, down to $14.5 million, mostly because incentive fees were lower.
Okay.
So the net effect, net investment income actually rose, went up to $9.1 million from $7.2 million. So yeah, fewer one-time gains, but the core operation looks cleaner, more efficient.
Cleaner, more efficient. And that brings us to something really unique about GAIN, doesn't it? That 0P income strategy.
Yes. The CFO, Taylor Richie, made a point of highlighting that. We are one of the few, if not the only, that has 0 PN income. And just to clarify for everyone, PM, payment in kind, means getting paid in more securities like an IOU instead of actual cash.
Right, more paper.
Exactly. GAIN focuses on cash interest. That's a huge strength, especially when credit markets tighten up. It means their income is real, tangible cash, not just paper promises that might dry up.
Much more stable.
Way more stable. Plus, they have that unique exit fee thing that's off balance sheet until they actually collect the cash. Reinforces that cash-centric approach.
Okay, that's a clear advantage. Now, what about the health of the existing portfolio? They mentioned 4 companies on non-accrual status. Should we be worried?
Well, 4 sounds like a number to watch, but management seemed pretty calm about it. They said no broad credit concerns across the portfolio. And actually, they expect one of those four to get back on accrual status next quarter. Sounds like they're actively managing those situations.
Proactive management? Good. And connecting that back to their overall strategy, they're consistently targeting companies with, what, $5 to $12 million in EBITDA?
Correct. That's their sweet spot.
But the M&A market is super competitive right now, right? They mentioned sometimes walking away if prices get too high, like offers hitting 9x EBITDA when they're only comfortable up to maybe 7.5x.
Yeah, very competitive.
So how do they actually win deals without just throwing money around?
It's about how they structure the deals. They often combine equity and debt investments. That lets them offer a package that's attractive beyond just the highest price tag. For example, these new deals, Smart Chemical, Sun State, Global, Grab the Debt Parts, have 13.5% floors.
13.5% floors, meaning even if rates drop, their income from that debt won't go below that level.
Precisely. It gives them predictable income streams, protects them from rate drops, shows discipline, but also flexibility in how they make deals work.
Smart. Okay, but what about the wider economy? Management sounded a bit cautious there. Mentioned tariffs, maybe a slowing economy. How's that hitting their portfolio companies?
It's definitely a factor. They said for some of their consumer-focused businesses, it's creating margin pressure. They're having to look hard at supply chains, find alternatives to deal with tariffs and inflation.
So it's a real challenge.
It is. But management stressed they're working closely with these companies on solutions. It's not just identifying the problem, it's actively helping them navigate it. They believe these companies can still service their debt, but yeah, those external headwinds are real.
Okay, let's switch gears slightly to distributions. Always important for BDC investors. They kept the monthly payout steady at 0.88 cents per share, right? That were 96 a year.
Yeah, steady monthly distribution. And don't forget that $1.54 per share supplemental they paid out in June.
Right, that came from successful exits they had. Shows the model working, generate gains, share them with stockholders.
Exactly. And they had a big chunk of undistributed income spillover from the last fiscal year, about $1.50 per share. They used roughly a third of that for the June supplemental. Their target overall, based on yesterday's close, is about a 10.6% distribution yield for the fiscal year. That's a strong commitment to shareholder returns.
Okay, so pulling it all together, what's the big picture here for you, the listener? It feels like Gain's Q1 results, even with that tiny revenue miss, really signal this strategic acceleration. They're deploying capital faster.
Yeah, shifting from maybe a more cautious stance to being much more active, looking for both income and NAV growth. It feels deliberate.
And that acceleration, plus the strong balance sheet, the buyout strategy, and especially that zero PIK income, it gives them real resilience, doesn't it?
It absolutely does. It sets them apart in a tough BDC sector where everyone's grappling with rates and deal competition, positions them quite well, I think.
And the performance numbers kind of bear that out. Total return's been strong.
Yeah, up nicely over the last month. Year to date, they're actually beating the S&P 500 pretty handily. And the one-year return is impressive, too, around 31%, shows the strategy's working.
Still, we saw that muted stock reaction right after earnings.
Right. Investors are cautious, weighing the good stuff, the EPS beat, deal flow, liquidity against the revenue slip, and those broader macro risks. It's that classic push-pull.
So looking ahead, what should we watch for? What are the potential catalysts?
Well, obviously, Q2 earnings will be key. Any more news on new deals or successful exits, especially exits that could trigger more supplemental distributions. And then, the big picture stuff, interest rate moves, general economic health. That affects everyone in this space.
And long term?
Long term, the path seems clear. Keep that high yield going while growing the portfolio carefully. If they execute on that, they'll really cement their place as a top-tier, well-managed BDC.
All right. Time for our not financial advice segment, where we toss around some slightly out there, but maybe just plausible trade ideas.
Love this part.
Okay, so based on everything we just talked about, Gain's momentum, the zero PI angle, their defensiveness, here's a pitch. Imagine we're in front of the investment committee. Long game. Short a basket of BDCs that rely heavily on PIK income, specifically targeting those whose stock prices are trading at a premium to their NAV. What do you think? Too crazy?
Bold. Long game, short, high peeply BDCs trading above NAV. Okay, lay out the thesis. Why that specific short basket? What's the biggest risk?
The core idea is simple. Cash is king, especially when credit tightens. Gain generates real cash. Its balance sheet is strong. They're actively investing. Meanwhile, those high PPDCs, their earnings quality, the actual liquidity in their portfolio, that could come under serious scrutiny if rates squeeze margins or the economy slows down. You're essentially shorting paper promises versus gains hard cash.
Okay, see the logic. The PIK income might not be as solid as it looks on paper if things get tough.
Exactly. And remember, gains NAV dip. That was them paying shareholders, not asset write-downs. So you're betting the market eventually favors that kind of financial conservatism and real cash generation over potentially less liquid reported income.
And the risk.
The risk is if the market suddenly flips back to a growth at any price mode, or if rates plummet unexpectedly, then maybe those high PI names get a boost. But I think the structural weakness of relying on non-cash income is a key vulnerability this trade targets.
It's definitely a bet on quality and tangible returns winning out. Interesting.
So that's our deep dive on Gladstone Investment Corporation's Q1 FY26. Strong EPS beat, faster investment pace, solid balance sheet, and that standout zero PIK model.
Yep. Balanced against that slight revenue miss and those macro worries that kept the market reaction pretty tame initially. But management seems optimistic about growth and keeping those distributions flowing. It's a story of resilience, really.
Definitely. Now, the usual reminder, everything you heard today is for informational purposes only. It is absolutely not financial advice. Please do your own research, talk to a qualified financial advisor before making any investment decisions. We'd love to hear what you think. Find us on social media, share your thoughts on this deep dive, or tell us what earnings calls you want us to tackle next. Until next time, keep those tickers talking.